Right. So, having done all of these workings so far, now I want you to pay close attention to something carefully here. I emphasized on something, that this convertible shares was there at the start of the year. Meaning it's been in the business for how many months? 12 months. So it is not that we issued it during the year, but it was there at the start of the month. Hence, we won't take into consideration what? The number of periods in relation to that. But the right issue thing is going to change. So let's see what happens. So outstanding shares before the right issue. What was the shares the company was having at the start of the year? What was the shares? 36 million shares. So 36 million shares. Now, when was this right issue made? 1st January. So 1st Jan. Now, what was the start of the year of the company? 1st Oct. So October, November, December. This thing was done on when? 1st January. Meaning this 36 million shares was outstanding for how many months? 3 months. So it's going to be times 3 over 12 times the bonus fraction, which was 38 divided by 36. What do I have? $9.5. Yo. Then shares after the right issue. Shares after right issue is going to be the outstanding shares plus shares on the right issues. So our outstanding share before the right issue was 36 million. So what was the number of shares on the right issue? It was 1 for 4, right? So 1 over 4 times 36. What do we have? 9. And that will give us a total of. Now you are doing Lotto or what? Hey, Charlie. So 45 million shares. This is 36 million. So 45 million shares. It will be there for how many months? 9 months. 9 months, because Jan to September. So 9 over 12. Remember, the bonus fraction doesn't apply to the shares after what? The right issue. So what do we have? $33. Okay. 33. Okay. 0.75. Are we done? No. We need to also bring what? The extra shares on the convertible loan notes. Which we did workings for. And that is going to be what? 2.5. Remember I said we won't adjust this, like it won't be affected because it has been there from the October to what? September. So it was there at the start of the year. Hence, it is going to be what? Full 12 months. Full 12 months. So we add it up and that gives us our weighted average number of equity shares. What do I have? 45.75. Now we can calculate the diluted earnings per share, which will be equal to the profit after tax, 15.6 million, divided by the weight, 45.75 million times 100 cents. 34 cents. That's it. So this is the answer to the question. Any question? So D. Explain and quantify how the closure of the factory should be treated in Pulse's financial statements for the year ended 31st March 2013. Explain and what? Quantify. What does it mean? Speak English or write English and then do calculations as well where possible. In other words, why will you include something in the financial statement and why won't you include it in the financial statement? That is why that statement means. So it is 2 in 1. So let's go to the question. At a board meeting on 1st July 2012, Pulse's directors made a decision to close down one of its factories on 31st March 2013. The factory and its related plant will be sold. A formal plan was formulated and the factory's 250 employees were given 3 months notice of redundancy on 1st January 2013. Customers and suppliers were also informed of the closure at this date. The directors of Pulsar have provided the following information. So up until this point, we know that on 1st January 2012, the management made a decision. 2013. The management made a decision. Then they to close down the factory by when? 31st March 2013. Am I right? Now, when is 21st March 2013? The end of the year, right? Because that is from the requirement I read first, the end of the year. So they will close it down by this time. Okay. For that reason, they have done a formal plan and they have informed the 250 employees they have on 1st January. So on that same day, they took, they made a decision on 2012. Another one? 1st July, not January. Okay. 1st July 2012 to close it by this time. Then on 1st January 2013, they inform what? The employees. Okay? Because per law, you must give the employees 3 months what? Notice. So they gave them 3 months notice. Now listen carefully. Then they also inform customers and suppliers that we will close down this factory. So let's see what the directors said. What did they say? Number one, they said 50 of the employees will be retrained and deployed to other subsidiaries within the group at a cost of what? 125,000. Okay, so retraining cost is 125,000. That is for 50 what? Employees. Make sense? First thing. Next one. The remainder will accept redundancy and be paid an average of $5,000 each. Okay. How many are they? How many are they? 250. So if we retrain 50, then the redundancy payment will be what? So redundancy payment will be 200 times. How much are we giving everybody? 5,000. What do we have? $1 million. 1 million. Okay. That's a redundancy payment. Factory plant has a carrying value of 2.2 million, but is only expected to sell for 500,000, incurring 50,000 of what? Selling cost. However, the factory itself is expected to sell for a profit of 1.2 million. Okay, what is happening here? What is happening here? The factory plant, okay, has a carrying value of 2.2 million. But the fair value less cost to sell is what? Selling price of 50,000, incurring a cost of how much? Sorry, 500,000. 500,000, incurring a cost of how much? So meaning the fair value less cost to sell on this asset will be what? For 50,000. Why is this important? It is important because, as you can see, it means there is that boy inside, impairment. Because we say that an asset has suffered impairment when the recoverable amount is higher than what? Sorry, when the carrying value is more than the recoverable amount. So, meaning that embedded in this plant, the plant is going to suffer an impairment. So, carrying value minus recoverable amount. So, in this case, the recoverable amount is the fair value less cost to sell. Now, we can't get value in use here because we want to close down the factory. So, impairment will be the 2.2, which is 2,200 minus what? 450,000, which is 450. What do I have? 1,750 dollars. So working in thousands. So what does it mean? It means this impairment loss has to be recognized in the current year financial statement. It means that when we go to the balance sheet, the plant, which is going to be sold, must be recognized at what? The recoverable amount of what? 450. I hope you understand it. Because the examiner said explain and quantify. Into vocabulary, now we're explaining, now we'll quantify. That's the first aspect of the question. Next paragraph, the last paragraph. The company rents a number of machines under operating leases, which have an average of 3 years to run after 31st March. So listen, if we close at 31st March, our contract for leasing of the assets still will go for what? 3 years. Meaning the contract is not ended yet. The present value of these future lease payments as at 31st March 2013 was how much? $1 million. However, the lessor has said they will accept $850,000, which will be due for payment on 30th April 2013 for their cancellation as at 30th March 2013. Which one do we go for? The present value of the minimum lease payment. When we did the calculation, if we are working in thousand, is 1,000, 1 million. But the supplier, the lessor says that he will accept how much? How much will they accept? 850. Which one do we make provision for? Do you agree we need to make provision for this? Because this has to be paid on 30th April. When is 30th April 2013? 2013. When is 30th April? Just the month after our year end. So which one do we provide for? Is it our minimum lease payment or what the supplier has agreed to take? We must choose one. Which one? It's over to them how. You is definitely we pay. The supplier said 850. So why will you recognize 1 million? So it's the 850 you recognize. So this 850 will debit the income statement, right? With that 850 because it's an expense, and we credit what? Current liability. 850. With the amount that the lessor says he will accept in relation to the cancellation of asset lease. Of leased asset or leased machine. I hope we are getting the picture. Until who call now your calculation, who call now your calculation. Now, let me come back to this before we take the final slide. The retraining cost of 125,000. How do we account for it? Do we capitalize it or write it off? We write it off. Okay? So meaning this goes straight out to where? The income statement as an expense. What about the redundancy payment? How do we account for it? Income statement, because we have to make provision for it. So we debit the income statement and credit what? Current liability, right? Because we are going to pay them when? Okay, we are not told when, but we'll pay them certainly. So it will be under what? Current liability. Under current liability. So what are they? The retraining cost is going income statement. Redundancy is going to income statement and balance sheet. Impairment, straight up, income statement, then the cancellation of the lease machine, income statement and what? Balance sheet. Last statement there. Penalty payment due to non-completion of supply contracts are estimated at what? 200,000. Because we are closing down the factory, we have a supplier who we have a contract with that they should supply us. But if we cancel, we have to pay a penalty. So the estimation of that penalty too, we need to make provision for it. So penalty. That is what? 200,000. So since it is estimated and we are going to be paying, we will debit what? The income statement and credit what? Current liability. That's it. We are done. Any question? Any question? Does it make sense? So if I want to prepare a financial statement, extract, income statement, that's an extract for the year ended Ibazi. What's that? So what are we bringing here? So maybe we can number our workings or whatever. Do we number? So let's say workings 1, workings 2 for the impairment, workings 3 for this, workings 4 for that. No, that's the 4. No, yeah.
The 4 is the...
And then the penalty will rather be 4. Because even now we don't need workings, we just bring it straight up. So let's go. Retraining cost. How much? 125. We go. Redundancy. 1,000. Impairment. How much? 1750. Yes. What else? Lessors, cancellation of lease assets. Of leased machine. How much? We are going to pay what the supplier said they will accept, and then penalty payments to supplier. 200. They are all expenses, okay? So you add all of them up. Can I clean my board? Hey, so put it down and let's go. Now, I just realized something. 50 of the employees would be retrained. Within the group at the cost of 125,000. Would be retrained. Meaning, we've not incurred that retraining cost. It is not supposed to come. Are you getting the idea? We've not incurred that cost. So it's not supposed to what? Come. Are you getting the idea? It's not supposed to come. Until we incur it, then we recognize it. So that one has to be out of there. It's not something that we have to bring it there. But the redundancy, we need to make provision for rate. So in our balance sheet, if we are preparing balance sheets, statement of financial position. Remember in the question we were told that the factory itself will be sold for a profit of what? 1.2 million. But we don't know the cost of the factory. So that information, we are not going to use it for what? Anything here. Okay? Because estimated profits, we can't use it for anything. So the only thing we will bring is that under current assets, sorry, what did you say we bring? Yeah, under current assets, the plant will be carried at what? Into recoverable amount of 450,000. Then it's what? Why is it non-current asset? It's going to be sold, so it loses to become a non-current asset. Yes. Then we come to liabilities. The redundancy. Of 1,000. The cancellation of the lease contract. Or leased machine of 850, and then the penalty to the supplier. $200. That's it. Now we don't need the totals, okay? We don't need the totals. So that's all there is. So question 4 is on interpretation of financial statements. So when we go to the requirements, it says analyze the financial performance and position of Greenwood for the 2 years ended 31st March 2007. Note, your analysis should be supported by 5 appropriate ratios and refer to the effect of the discontinued operation. Very important. Very important. So the examiner said we should just calculate 5 what? Appropriate ratios. Now we should take into consideration what? The discontinued operation. The effect of the discontinued operation. So let's go to the question and let's see what the heck is there. Greenwood is a public listed company. During the year ended 31st March 2007, the directors decided to cease operation of one of its activities and put the assets on the operations up for sale. The discontinued activity has no associate liabilities. The cessation qualifies as a discontinued operation and has been accounted for accordingly. Note, the statement of profit or loss figures down to the profit to the period for the period from continuing are those of the continuing only. Okay, so we are told that the statement of profit or loss figures down, like below here, down to the profit for the period. So look at it. Look at the statement one. The reason I'm taking that again is for you to understand what the examiner is saying. The statement of profit or loss figures down to the profit for the period from continuing operation are those of the continuing operation only. So down to the profit for the period are results from the continuing operation, meaning the business that we are continuing, excluding the effect of what? The discontinued operation. Are you getting the idea? So we have given the 207, 206. Let's go to the flip side. No, still under that flip side. We are told that analysis of discontinued operation. Now listen carefully. From the top here to the profit for the period are results from the continued operation. That is the business that is still part of the assets of the company. But what we are about to go through now is the revenue generated or the profit statement from what? The asset or the part of the factory which was what? Discontinued. So that is what is on the flip side here. Their revenue is 7,500, blah, blah, blah. And we see their tax relief, we see their tax relief from the group, all of that there. Then we see statement of financial position also has been given to us there. Note, the current amount of the assets of the discontinued operation at 31st March 2006 was how much? 6,300. So, the examiner said calculate 5 appropriate ratios. If you check the balance sheet, asset held for sale at fair value, what do you see there? What do you see there? 6,000. So for the year 2007, the 6,000 is what we will take into consideration. But we are told that at the 31st, when is 31st March 2006? That will be the last year. The last year it will be what? 6,300. So the examiner said we should analyze for the 2 years. And we should calculate 5 appropriate ratios. So what 5 appropriate ratios you think we are supposed to calculate? 5. Just 5. Rosie. Okay. So what is Rosie? Profit before tax over what? Capital employed times. Alright. Okay. We are doing for 2 years. 2007 and what? 2006. So what is the profit before interest, profit before tax, sorry, for 2007 from the question? Profit before tax for 2007. Remember the examiner said our analysis should take into consideration what? The effect of the discontinued operation. That statement is very, very important. Very, 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 very important. So, what is the profit before tax for 2007? 4,500. But you see, the examiner said we should take into consideration what? The effect of the discontinued operation. So let's go to the discontinued operation and find out what is there. To the discontinued operation specifically, you will see that, look at something. There is an item there called tax expenses received, 300. Can you see that? Then there is tax relief on disposal group, 400. Can you see that? Can you see that from the discontinued operation? You see the 300. Have you seen the 100 too? Now, taking into consideration the effect of the discontinued operation, meaning that this effect here, okay, this figure here, 4,500, includes the results of what? The discontinued operation. So the tax that they have, we have to come and what? Add it back to this figure. So the 300, the tax relief there, and then the 100 here will be what? 400. That has to be added back to the profit before interest and tax. This is why I said.
I was thinking when we are doing this for the discontinued operations, because I calculated the separately.
Okay.
So I was thinking when we are doing the discontinued operation, that is when.
No. Okay, you did without the operation and with the operation. No. It has to be integrated in one calculation. It has to be integrated. Then divided by, what is the capital employed? What's the formula for capital employed? What? Let's go to their balance sheet. Shareholders fund. Okay, so what is the shareholders fund? 14,500 plus long-term debt 8,000. Can you see that? Name tier. This shareholders fund, you know, this is the same as total assets minus what? Current liability. You know that. But the total assets include the discontinued operation. True or false? Because as you can see, the discontinued operation, the asset held for sale 6,000 is there. So I say it's free. That's the principle. That's the principle. So times 100. Where Diego Kra off guard. What do we have? Fastest and please. 29. 6 what? So 29.7%. That's for 2006. 207. So let's go to 206. 206. What is our profit? 206. What's our profit?
3,500.
Yeah. Is that? You had 75. Hubert is wrong. 4,500 plus 400. This plus this minus this. Yeah, this is 14. We go 2006 profits. Then in 2006 from the discontinued operation, what is the information there?
Tax expense.
Tax expense of what?
130.
Who say as tax expense slash what? Relief. Now what is the meaning of relief?
It's a waiver to them.
So relief reduces what? Our tax. Minus 130. Then any other information about them? Okay. So 130 there. Let's see.
So the income tax.
Which one? Where is the income tax? So we go. So in the year 2016, we're going to have 3,500 plus how much? Plus how much? They are tax relief of how much? 130, right? Divided by?
The 130 is a bracket.
Okay. So that's a relief. So that should reduce our tax effect, right? Okay. So let's see. Profit from operation 3,200. And then the tax relief. Okay.
So I was thinking.
Okay, so wait. Okay, yeah, tell me. There.
300.
With
I was
300.
thinking that is the relief.
Yeah.
Then the expense will be the 180.
Yeah. You know, we are taking profit before tax. Are you getting it? Profit before tax. So with the profit before tax, meaning these tax were paid. And nothing of 3 and 4 no. Sorry, 3 and 1 and 4 now add it back no, because we are taking profit before tax. Are you getting it? For you see, this result here is from the continued operation, which is what I emphasize on the top here. But so if you are taking the discontinued operation into consideration, then that, yes, we need to take it out. So if you check, okay, so this is a relief. Now how much profit did they make for the year? 320. Now so yet relief the free 320 Nima, what are we going to have? One. Alright, so if this is a relief, meaning that 2006, they didn't pay any tax. Rather, their tax responsibility was reduced. But if you check also, you realize that in the year 2000, okay, so we started from 3,500. Okay, so if this is a relief, it has to be deducted, right? It has to be deducted because relief means it reduces what? Our tax liability. Hence, it has to be deducted from the effect. Now, what is the capital employed? Shareholders fund 2016. 12,500. Can you see that? Plus long-term loan 5,000 minus what? The discontinued operation. But I had a 6,300. Sounds good. 2007 it is 6,000. But 2006 it is what? 6,300, because that is what the examiner what gave us. So we can times 100. What do I have? So very important. So 30.1%. 30.1. So what other ratio can we calculate? Appropriate. So Rosie, we need to also calculate gross profit. Okay. So gross profit. How much we got? Formula for gross profit. Formula. Gross profit over sales times 100. So 2007. What is the gross profit? I want to go here. Send me a 8,000. Okay, and the sales figure also is. Now, why would you say 8,000? You see that, in effect, when we are talking about gross profit, what are we talking about? Okay, I'm coming. Let me see. Okay, so yeah, it's that 8,000. 8,000 over sales. So sales is how much? Times 100. What do we have? %. 29.1%. What else? 2006, we go. 6,200. What do we have? 29.2. What else can we calculate? The net profit what? Margin. Formula. Profit. Profit what? Net profit. But you know we will still be using profit before tax, right? We'll still be using profit before tax here in relation to that. You know, no, we will bring profit before tax because we won't take into consideration tax. You know, I told you that tax is charged differently. So even when we are doing the net profit margin, we will still be using the profit before what? Tax. Because comparatively, 1 year tax will be different from what? The other year's tax. So that's why we have to take that into consideration. Okay. Okay, so let's go. So net profit, what do we have? Net profit, what do we have? Net profit margin, what do we have? Okay, give me formula first. Profit before tax over what? Sales, am I right? We go 4,000 over
27.
4,500 over 27,500. 16.4%. Okay. What?
2006.
Okay. Profit. 3,500.
21,200.
21,200. Also, oh, okay. So like almost the same thing. Okay. What else can we calculate? Maybe we can calculate some liquidity ratios here, right? Because, yes. You see this one, it says 5 appropriate. So usually, maybe somebody may just calculate ROSI and calculate net profit margin and then do liquidity. Are you getting the idea? So it's judgmental, like it depends. So liquidity ratio. Do we do quick or current? Which one? Or the two?
The two. Yeah, the two.
So current ratio formula.
Current assets over
Current assets over current liabilities. So 2006 current assets. What do we have? 2007 current assets.
That was, you know, so the financial statement represents, you see what I was doing there, consider this.
Yes. So that is it. So current assets, what do we have there?
Current assets, we have
9,500. Current liabilities.
4,500.
What do I have?